Good morning. It's Friday, May 16th. I'm Zach Howard. Here's your morning market update. Big monthly options expiration in U.S. equity markets today with over $2.8 trillion in notional options expiring, 1.2 trillion on the SPX options, and 580 billion notional on single name companies such as those mega cap 7, etc. So a big day. Options probably get rolled. There's been a lot of put buying over call buying in the last couple of days. Are we set for a slight pullback before the next leg higher? Don't know, but that volatility, that VIX reading, that continues to fall. It could fall back to 16, even maybe 15 today, which will push the S&P 500 above 6,000 again. Wait and watch to see what happens. But we have volatility in a bearish trend, and the SPY and those mega cap names, all except for Apple and Google, the only ones are not yet back to bullish trend. Sell in May and go away. That is the old Wall Street acronym. Is that the case this year? Don't know. But what we're looking at is a major historical move over the last month in the S&P for only the sixth time in its history. The S&P has gained 18% over 25 trading days. The 5 other times that happened in history, where was the market 250 days from then? It was always positive 100% of the time, with an average return of 11.4%. Average return of 30%, low return of 11.5%, and a high return of 43% based on this chart. But where are we to? Where are we to at the end of the day? This is a chart of the S&P 500 on the top, and on the bottom is the earnings per share of the S&P 500. Now trailing at a trailing 12-month earnings ratio of almost 22 PE. So valuation is not a catalyst, but just take in context what you're paying for when you buy a share of the S&P 500. You're basically paying ribeye steak prices for something that is a sardine type quality protein when you get these type of valuations. Doesn't mean the market's going to sell off anytime soon because of that. But we are in frothy areas when you look at a traditional finance metric standpoint. And a lot of this is just driven by flows, automatic positioning based on volatility. And I just talked about the big options expiring here today, 2.8 trillion. Bigger picture, though, everybody keeps using the R word in financial media: recession, recession, recession. Can we even have a recession anymore based on our fiat monetary system, where we adapted to whatever was happening? We could not have any temporary pain. So specifically, we couldn't have any long-term pain. Either the Treasury or the Fed came running to the rescue each time. In this last instance, it was not the Fed. It was the Treasury that stepped in when bond yields started to get elevated, and Trump walked back the tariff talk, and suddenly we're back to everything's all good again. I don't see us having a recession in the near term. We have a slowing of growth potentially, but we're going to probably get a pickup in growth into July, August, just because of the bump up now in new orders from Asia with the tariff relief, etc. So haven't had a recession. Based on the fiat monetary system, the tools available, why would we expect to have one? They'll just come to the rescue once again if times get tough. The stock market is a national treasure and a national security issue because of the concentration of fiat wealth in there. However, what stops this train is no politician. No politician is ever going to get elected or reelected on austerity. It will simply be math. A is A, as Ayn Rand will say, and eventually the bond market is going to say, hold on a second, guys. There's not enough money to go around to keep feeding these massive fiscal deficits. Those gold bars there is this fiscal year currently with the new administration. They are spending more than the previous administration was spending historical record deficit spending. If we look at where markets are to in terms of a longer term perspective, over the next year, there's 9.2 trillion in U.S. debt that needs to mature and get refinanced. If we're assuming it gets refinanced around current rates and that U.S. 2-year to 10-year average, that's what the yields are, 4.25%. That's going to make up a fiscal deficit spending on this fiscal year of approximately $1 every $5 is going to go just to servicing the interest on the debt. Keeping the can down the road for policymakers. That's the game. None of this debt is ever going to get refinanced. The idea is to keep rates low so we can continue to spend and keep this whole game going. That's what fiat and a monetary system is. Politicians ain't going to stop it. The bond market is probably the only ton to step in. And we got like this 30-year yield, looking back the long-term trend, 10 years, up at these levels of 5%. 5% doesn't really matter. It matters because of the math, because where the U.S. is from a fiscal and a long-term debt standpoint now in 2025 and going forward versus it was 10 years ago, it's double the debt. 18 trillion back in 2015 when rates were lower than they are currently. We're now up 37 trillion and rising. So who stops this? The bond market. That's the only one that stops it eventually. But we got lots more tools in the fiscal and the monetary standpoint policy book before that ever becomes a reality. They can adopt Bank of Japan policy. Ultimately, the fiat system is dependent on continued debasement of the currency and rolling over this fiscal debt. Looking at shorter term, we probably get a reflation in growth, which means gold and some gold proxy trades don't do so well. More like tech, industrials, commodities in the shorter term. Bitcoin continues to be a strong signal, whereas gold is losing some of its momentum. And we're back into a higher beta phase, I think, shorter term, despite the long-term outlook. Have a great weekend. I will see you Monday. I hope you have a great weekend with your families.